Hello and welcome to the FT headquarters. With me today is Nannette Hechler Fayd'herbe, Chief Investment Officer for International Wealth Management and Global Head of Economics and Research at Credit Suisse. We've been hearing a lot recently, a lot of talk about recession, and it seems to be having an impact now on equity and bond markets. How worried should we be?
I think if you look at manufacturers and companies that are active in industry, indeed there is a downturn and there is some worries to have, especially as long as this trade dispute and all the uncertainty that is related to it is continuing. It's really the manufacturing sector which has paid the price and has felt in some sense, the tension on the international trade side. However, if you're looking at the side of the economy that is more active with consumers and that is dependent on a good labor market, then things are looking really good. And this is not only the case in the United States, it's also the case in the Eurozone. So really, it's this two-sided picture of the economy, very much dependent in which of the sectors. And so far, we don't think that it will be enough to derail global growth, but for sure, there are sectors that are having quite some headwinds.
Now, you mentioned trade wars just then, which is kind of the big headwind that people are talking about. Is this a purely negative thing for the global economy, or are there some sectors and countries and regions that might actually benefit from these trade wars?
I think for sure that when there is a trade conflict, that has an incidence in particular on supply chains, as has been the case in this current setting. The response of some companies is to choose different locations for their production. So, for example, some producers that had their factories based in China have started to diversify into economies around them. And Vietnam has been one of the countries and economies that has, at the margin, been on the benefiting side of this trade conflict. But by and large, the impact is just on the negative side because of what it is doing to sentiment and to confidence in future prospects. So if you are an economy like Germany, which is very export-oriented, more than 50% of GDP are actually coming from exports. This is the weight of the export sector. Then this is obviously not a very pleasant time for many German companies.
Partially in response to this slowing growth, we're seeing central banks enacting looser monetary policy. We've seen the Fed shifting. We've seen the ECB indicating that it's going to do more. How much ammunition do the central banks have left? How much further can they go with these QE programmes? And what do they do when they've kind of exhausted these possibilities?
I think this is really what is the topic, probably even as early as the Jackson Hole conference and what has to be talked about. I mean, many central banks of developed markets are at the so-called zero bound. So what they can do on interest rates is to make interest rates negative. And what they can do is obviously increase money supply, create money. The question for them is just how effective is that as a stimulation policy? And I think increasingly they're coming to the realization that that alone will not be very stimulative, and that coupled with fiscal spending, it would have a much more stringent effect on stimulating, stabilizing the economy. I have noted with great interest that both from the US side, from especially the Eurozone, the ECB side, there has been the communication that fiscal policy is a very important other tool in the policy mix, and that fiscal policy in the Eurozone has now been austere and restrictive for probably long enough, and has to, in particular in countries like Germany that are running budget surpluses, has now to be envisaged as part of the next measures to take. So the answer is, I think there is still an impact to expect from central banks, but it has to be coupled to fiscal policy. And one way to think about it, really even more directly linked, is that, well, what speaks against a central bank thinking of creating money and instead of investing this in financial assets, as they did with quantitative easing so far, to invest it directly in infrastructure that is commercially used, that therefore has a return and stimulates the economy really quite directly.
And with all this going on, where do you advise your clients? How do you tell them to build portfolios at the moment? Can they protect themselves? Should they be going to risk-off mode? How should they be positioning their investments?
The first conclusion to reach out of the current environment, where both fiscal and monetary policy are likely to be there to support the economy, to extend the business cycle and to avoid a recession, is to say, well, interest rates are probably going to remain relatively low. We should be expecting a low yield and interest rate environment. And we should also be expecting that volatility, if it rises for a short period, it really should only be transitorily rising. In fact, when you have the preparedness to act and support the economy as we have now, we should be anticipating repressed volatility. And what this says is that actually investors should continue to be invested and to consider something else than cash, because a recession is likely to be avoided. Hence, financial assets, a multi-asset strategy in our view is a good starting point to diversify. And in that multi-asset strategy, we would continue to put the majority of the assets in equities, in the understanding that the recession is not just around the corner.
Nannette, thank you very much for joining me this morning.
You're welcome.